Good morning and welcome to this Monday, March 16th edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we have got deep red futures once again. The big rally that we had in the final 45 minutes on Friday felt good at the time, but we are in an extremely volatile period. And this morning we're looking at futures opening up considerably lower. The S&P 500 futures, well, first of all, overnight, we did hit the trigger on the futures. So there's a lock limit in place when we get down 5%. So the market had triggered overnight. And then this morning, I just looked a little bit ago, and we're looking at probably triggering one of the circuit breakers at the open, so we'll probably have a 15-minute delay. But last time I looked at the S&P was looking to open down about 10% this morning. So it is going to be another one of those rough Mondays with a huge gap down. I'd like to have a lot of good news, but I don't have a whole lot of good news. We'll go through a lot of the numbers and a lot of the charts and take a look at where we are and try to look at it rationally, because really we're looking at an irrational market, which is very difficult to look at rationally, but we'll go through it step by step, take a look and see what's going on. Before I get into any of that, let's go ahead first and take a look at what happened on Friday. You can see that the Dow Jones Industrial Average did finish up almost 2,000 points, 9%. The S&P 500 up also 9%, 230 points. The NASDAQ was up 9 1/3, 673 points. Mid caps and small caps again both underperformed. They both had big rallies, but once again, I can't even tell you how many days in a row it seems that mid caps and small caps have underperformed. But this is just not the place to go. And you can kind of look at the PPOs up here and get a sense. With the Dow Jones Industrial, you can see getting close to -6. The S&P probably closer to -5. NASDAQ a little over -4. And then when you look at the mid cap and the small cap, you're looking at close to -7.5 and more than -7.5 on the small cap. So the momentum to the downside is definitely greater. That momentum to the downside definitely greater on the mid and small cap stocks. Among the sectors, you can see financials led the rally. We've gotten a little bit of pop, not so much this morning, but last week we saw a pop in the 10-year Treasury yield. That certainly helped the financials. Banks did well, investment services, life insurance, the companies, the industries that you would have expected to rally with a little bit of rally in the 10-year Treasury yield. That's what we saw, financials leading. Technology continuing on a relative basis to trade pretty well. Yeah, we're in this downtrend. Of course, there's not too many places to look right now where you don't see a downtrend. But on a relative basis, I think this is a group. And again, you can look at that PPO where the XLK is right now on the daily PPO, a little bit more than -4, which is better than just about any other place. You can see the real estate doing a little bit better. But energy up 9%, communication services up 9%, and real estate up almost 9% on Friday. So it was a good rally on Friday afternoon, and it was after President Trump started his speech a little after 3 p.m. But there were still pockets of weakness, and I know I recently have talked a little bit about the consumer discretionary area. I think consumer stocks are at a lot of risk because of the coronavirus and the impact that it's going to have. I mean, when consumers lose confidence, which they have quickly lost, it's amazing how fast confidence has deteriorated. But when that happens, people don't want to go out. They don't want to shop. They don't want to go out to eat. Don't want to go buy a car. Don't want to go buy a house. I mean, all of those things come into play. And so as we look out over the next, 3 to 6 months, I mean, there's no doubt that there's going to be economic ramifications. There's going to be an economic downturn, and probably a rather quick and severe one. And that's what the market's pricing in. So as the news gets worse going out the next few months, I believe the stock market will stabilize. But the question is, where is it going to stabilize? At what point will it stabilize? And we'll talk about that in just a minute. Let's take a look at that 10-year Treasury yield. This morning we had the March Empire Manufacturing Survey come out. Market was expecting a 4.8 reading. It was minus 21.5. So I think this is kind of the start of some of these reports that I believe are going to be a lot worse than expected. And the charts are telling us that. The stock market doesn't sell off if there's not going to be some kind of a change in terms of fundamentals going forward. So get ready for the bad news that's going to hit, the fundamental news that's going to start hitting. I suspect we will probably get a little bit of that when we get the jobs report at the beginning of April. I think that you're going to see a really big change in the jobs report. And that's likely to result, if that continues, which unless we get a V bottom on the coronavirus and things start to really settle down, I suspect we're going to be in for a few months of negative reports in terms of jobs, and that should coincide with a recession. I wouldn't be surprised if we do get a recession. Now, looking long-term at the stock market, you can be in a long-term uptrend and still have, 1987 is probably the best example. We didn't have a recession then, but we had a huge drop in stock prices, tremendous loss of confidence in the market. And then, of course, we saw both. We saw a severe recession back in 2008 and 2009 as we went through that whole period. And the market, showed that in terms of stock prices. But here on the 10-year Treasury yield, you can see the downtrend that's been in play. This is a 40-year monthly chart. And I'm going to focus a little bit more on longer-term charts, simply because everything is broken on the daily chart. So looking at that really doesn't provide as much perspective on what's taking place. So the 10-year Treasury yield here, you can see huge drop recently. The good news on the flip side, and I'm going to try and find some silver linings in what's taking place. There's not a lot, but there are some. The one thing is, once we get out of this, I believe that the environment is going to be very strong for a quick recovery. You're going to have historically low interest rates, not just historically low, we're going to have the lowest we've ever seen, which is what we have right now. And you're going to have a lot of stimulus. We're already starting to see it. Over the weekend, the Fed acted in a pretty big way, cutting interest rates 100 basis points, and then offering up a stimulus package that includes quantitative easing of $700 billion. So the Fed, I think you're going to see an economic stimulus package coming from the White House and Congress. I expect that's going to be pretty swift and probably announced this week. There are going to be some positives for the economy once we get beyond that, or beyond this. But right now, this is, it's definitely about the economy slowing, but it's really about fear. When the stock market gets fearful, it is, everyone sells and asks questions later. It's always overdone to the downside. And that's why when you see these huge volatility index readings and the really high equity only put call readings, when you look back at history, when we see those, they mark really significant bottoms in the stock market, because when people are fearful, they're irrational. Everyone is irrational. You think everything's going to zero, and it's not going to zero. I don't know where it's going, but it's not going to go to zero. If it goes to zero, the stock market won't be the only problem we have, that's for sure. But I don't believe it's going to zero. I don't believe it's going anywhere close to that. So we've got to try to look at things from a more rational perspective, which is difficult in an environment that is so irrational. I want to talk a little bit about I said that there was some silver lining. And so I want to talk about a couple of things that I think continue to show a silver lining. Number one, in a recession, and especially in a deep recession, growth stocks should get absolutely hammered to the downside. We saw this back in fourth quarter of 2018. You could see the big drop. That's when growth slowed, and there were a lot of fears about the trade war. And then, of course, in my opinion, a lot of it was also due to the Fed not acting nearly quick enough. There were multiple reasons, and we could debate that all day. But my point is, when the market anticipated a slowdown and a problem, the growth stocks underperformed the value stocks pretty considerably. Now, if we looked at correlation, and looked at this ratio versus the stock market, it's not going to be a perfect correlation. In other words, every time you look at this chart and it's going up doesn't necessarily mean the stock market's going up. And I think the current period is a perfect example of that. But what it does tell me is that investors are not throwing out those growth stocks, at least not to the extent that they are value. And so why would that be in the face of all of this fear and in the face of a slowing economy, maybe even a recession? Why would folks hold on to the growth stocks? I think it's a positive. And I, at some point, expect this to come back down. I mean, this has been crazy, and maybe it will. Maybe over the next few months or next couple of months, we'll see that pullback. But the fact that we remain in this long-term uptrend, I think, is a bullish, longer-term signal. I don't want to say anything is bullish when you've got the VIX at, well, Thursday's close was 75. You hit the equity-only put-call ratio at 1.28 on Thursday. There was only one day back in 2008 where we had a higher reading than that. That was 1.35. So everybody is betting on the negative side, on the bearish side right now. And they're winning for sure in the short term. But it's like a rubber band. And that rubber band only gets pulled back so much. And when it snaps back hard in the other direction. And that's been the history of the market. So this was the IWF. Now, I also want to go in, I want to show you, bear with me, because I'm going to pull up this spreadsheet. You all have seen this before. And I don't know if I can bring both. Yeah, bring both of these up at once. Hopefully everybody can see this, both screens. I don't know if you're there, Aaron. Is this coming across?
Yes, it's coming across.
I'm sorry?
Yes.
Okay, good. Oh, I must be, I don't have my headphones plugged in right here. Hold on one second. I might not be coming across as well as I can. Let's try this. Is that better? Can you hear me better now, Aaron?
Yeah, you sound great.
Okay. Well, I wouldn't say great on this kind of morning, but better. I'll take better. Yeah, I just realized I had my headset plugged into my other computer, so sorry about that. Looking at this, what this is it's comparing 2020 to 2008. So it's the coronavirus and the economic issues that we have going on right now versus what we had the financial crisis in 2008. And, you know, I've said for the past few weeks that to me, I thought it felt a lot worse in 2008. I certainly feel like things are starting to feel even worse now. I don't know if it's worse in 2008, but I feel like it's building, and I don't know how much of that is media and how much of it is real. But I try to get my news from proper sources on the coronavirus. I'll go to the CDC, the WHO. I'll look for, you know, writings from infectious disease specialists and so forth. And most of what you read there is somewhat encouraging. It's capacity issues more than anything. And I don't want to get into a whole lot of healthcare discussion because I'm not an expert in this. But I think that, you know, the steps that are being taken and the extreme measures that are being taken and are likely to be taken. I had a member write to me, I think it was the end of last week, maybe on Friday, asking my opinion about whether the stock market will close, whether Wall Street will shut down. And they did that in China. And it seemed to work. And I definitely think that it would help the panic that's taking place right now. So I think the odds are growing. If the panic doesn't stop, I wouldn't be surprised if Wall Street shuts down for a week or two. And it's hard to say which side. I don't think I'd want to be short if they shut down for 2 weeks, because if they come back and there's any good news whatsoever, I think that could result in a pretty big move to the upside. And if you look at what's happened over in China, their market has held up a lot better than ours. And we could argue back and forth, you know, responses and who did what and so forth. But point is, they shut down their market. They really tried to isolate and contain. And when they came back and it reopened the market was much more stable there than it's been in any other part of the world.
So maybe we could learn something from that. Maybe it would be a good time to shut the market down for a period of time, like we are other businesses. Kind of makes sense to me. But anyway, when you're looking at this is 2020. And what I did is I looked at the spider and pulled up the close at basically near the top, at the top or near the top, Friday, February 21st. And then I put on here the opens and the closes each day after. So over here, we've got the open, then we've got the close, open of the 25th, the close, open the 26th, the close, and so forth. And what I was doing was simply trying to figure out how much of this moved to the downside, because what I was noticing is we were getting a lot of big gap downs, and then the market wasn't really doing much. The balance of the day, it was either going up or maybe it was going down some, but it was offsetting. So I decided, well, I want to see this in writing. I want to, put a spreadsheet together and actually quantify what I think I'm seeing. And so that was the whole purpose of this exercise. And so I went through, and the last time I showed this to everybody, it was after March 9th. So it was at the end of Monday. I think we did a webinar. And so on Monday, March 9th, I showed how the spider had gone from 333.48 down to 274.33, but the opening gaps, we actually had gapped down a net amount of 53 points during this period, and the spider was only down 59. So 90% of the selling was occurring at the open, and only 10% was selling throughout the day. And then I went through and I just updated this for the last 4 days, Tuesday through Friday of last week. And it's changed a little bit. We're getting a little bit more selling in the balance of the day, but still from where we are, or from where we were on February 21st to where we are now heading into today, we had dropped 19% on the S&P. And by the way, if we go back here and do the same number of days in 2008, it was 21.9%. So the majority went down those first 11 days, 17 versus 19. And then the next 4 days, you can see another big drop. Now, remember back in 2008, we had another big drop in November, which obviously the spreadsheet hasn't gotten into. And so when I wrote my articles over the weekend, Chart Watchers, and I think last week in my Trading Places blog, it may have been Thursday or Friday, one of the things I've said is we've put in what potentially could be a bottom, but I still think there could be one more. And just like in 2008, where we kind of set, we raised the bar in terms of volatility and fear, there's nothing to say that this doesn't, raise the bar. We might see something that goes beyond what we saw back in 2008 in terms of fear based on the VIX, based on the equity-only put-call ratio. But just keep in mind as you're approaching the market that we are seeing extreme irrational behavior in the market. And I know watching the market, thinking, oh my gosh, I don't want to, I'm just going to get out. I can't take getting up to another down day. I think you really have to reflect back, use some perspective as to why you're in the market. And if you're longer term, you've got money, but you don't need it for 10, 15, 20 years. Really think about your decision, what you want to do here. I can't make that decision for everybody, and I understand it's a fearful situation. Everybody's got to do what they feel is appropriate. But if you're on the long side in the market and you're a longer term investor, I would just simply remind you to go back and take a look at what happened back in 1987, what happened in 2000 to 2002, 2007 to 2009. We went through some really rough periods, and years later, 5, 10, 15 years later, the market was in much better shape. So to me, what's going on here today isn't, and what's been going on for the last few weeks, to me, it's more of a short-term issue than it is somebody who's got a long-term perspective. And especially if you're in, if you're still in a 401k and you're still contributing, I would absolutely continue to contribute. I mean, the prices that you're seeing, if it keeps going lower, you're buying in at even lower prices. I would definitely not suspend my long-term. If I was younger, and I'm talking about 30s, 40s, even into the 50s, if you've still got, 15 years or more to retirement, I'd be using this to continue to buy in at cheaper prices. I mean, that's what history tells us to do. All right, so this was 2020. Now, when I look back at 2008, the difference was that as of the first 11 trading days of that panic down move, we actually gapped up. 9.5%. And so we actually had gap ups here, 2.13 from one. We went from 116.06 down to 93.77, but we actually went up in the opening gaps a net amount. So we had some ups and downs, but the net was we actually gapped up. All the selling occurred during the day, 110% of it. So even more than 100% of it was during the day. And then as we went through the next few days, you can see it came back down a little bit, but still, this is a completely different look and feel, what's going on now versus what happened back in 2008. And I can't tell you, because we don't have a large sample size, I can't tell you what that means, but just, you know, from a common sense standpoint, if you've got institutions that are getting out, you know, you can't just say, well, put in an order for 5 million or 10 million shares at the open. I mean, maybe you can, maybe they are getting out in that way, and that's why we're seeing such large drops. You know, market makers are taking their orders and giving them the low price, so they're buying, and then the rest of the day, maybe they're distributing to others who are trying to, you know, bottom fish. I don't know. You know, I'm not a market maker, but I do find it odd that the majority of this move to the downside has been at the open, and we're seeing it again this morning with another big gap down. All right, I'm going to go ahead and take this back down now. And let's bring our charts back up. And I want to show you a, you know, kind of in the same light, you know, where we're getting a lot of gap downs and then we're getting buying during the day. If you're familiar at all with, I'm going to pull up Chart School. Let's go, I want to look at accumulation distribution. All right, so if you get into accumulation distribution, essentially, and here, I'm not going to go through the article, but I just wanted to point you to it, where you can go back and take a look at this calculation and see what's going on in terms of how this line moves. But essentially, what you're doing is you're looking at prices and where they finish end of the day versus where they are versus the prior day, if you know what I mean. So this is a good, you know, if you come over here and you look for accumulation distribution line, this right here, ADL versus OBV, it's a pretty good explanation and gives you an idea of why the accumulation distribution moves one way or the other, while OBV does the other. And Arthur Hill did a lot of these articles, did just a fabulous job. But look at a stock like Clorox here. This is a perfect example. I just want you to understand what goes on here. So you got a big gap down. OBV is only looking at the fact that you were down this day. You closed at 6104 right here, minus 170 on the day. If you're down on the day and the volume is high, you're going to have a big drop in the OBV, because the OBV simply takes the volume and subtracts it if it's a down day. The accumulation distribution is looking to see, you see all the selling way down here, but we came all the way back up. So all the buying that took place during the day appears to have outweighed the selling outside of the big gap down. You gap down, but then when you get all this buying and you finish back in the top half of the candle, under accumulation distribution, that's treated positively. And there you can see the pink line, the accumulation distribution, going sharply higher. So you've got the same candle, same day's action, but accumulation distribution and on-balance volume go in opposite directions. And so what I wanted to do is I wanted to come back here. I wanted to show you a chart, actually a scan. Let's do a scan. So I'm going to do a new scan. And I don't need any of this because I'm going to run it against my strong earnings chart list. So one of the things that I would do is I would go in, find my chart list, and sometimes in the daily market report, when I show you a scan, it'll come up and say, favorites list is 55. I've had members write me and say, well, what's that mean? Well, Stock Charts does that. I don't do that. All I'm doing is I'm pulling up strong earnings chart list. Then with that, I can go into technical indicators and go down and find accumulation distribution, which is right here. And then I can add it. Now the default is that it's going to pick up accumulation distribution versus yesterday's accumulation distribution. But I'm going to go in here and I'm going to say, what about versus 10 days ago? So what I want is all the stocks in my strong earnings chart list where the accumulation distribution is higher than it was 10 days ago, even though the market's gotten hammered. Maybe we can do 15 days. That'd be 3 weeks. Let's try this. So I can check my syntax, make sure that it works. Syntax is correct. So that means everything's fine there. I'm going to run the scan. Now remember, we have what, 370, 380 stocks in the strong earnings chart list. Half of them, almost half of them, have a higher accumulation distribution right now than they had 15 days ago. Think about how far we've dropped. And that gets back to these gap downs and then buying. So I don't know what to make of it. And I guess everybody can interpret it differently. I don't have the answer, but when I look at a stock like Apple, and I actually changed my default to include accumulation distribution here. But when you look at Apple, look at all the hollow candles. That is telling you that we're closing in the top half. Now, I'm going to, down at the bottom here, I'm going to put the OBV. See the difference? Accumulation distribution is going up. On balance volume is going down. Now, I don't know if this is going to play out, you know, in a few weeks or a couple months where everybody's going to look back at this and say that that was an indication that maybe institutions were using this as an opportunity to accumulate some stocks cheap. I don't know. It would make sense to me, but again, you know, trying to interpret exactly what's going on here with the market so wildly irrational and incredibly volatile, fearful, it's hard to decipher, you know, because again, it's not rational behavior, it's irrational. But anyway, I think that was, you know, an important scan. You know, when I ran that and I looked at it and I was just kind of shaking my head thinking, you know, half of all the stocks in our strong earnings chart list have accumulation distribution lines that are rising, which is crazy in this environment. If we look at the spider and just pull up the same chart, you can see the spider is actually down. So it would appear to me that the majority of the strong earnings chart lists are actually doing better than the spider, at least in terms of accumulation distribution. And whether or not that is something that's going to be significant longer term, I don't know. But it is something that I'm going to watch. I'm not going to get into earnings. There really weren't any major earnings this morning. Upgrades and downgrades, to be honest. Everything's going to be down this morning. I don't care if it's been upgraded, downgraded. Looking at individual daily charts doesn't make a lot of sense. So I'm just going to jump into the three you must see. And the first one I want to just bring up is the S&P 500. And I want to go back and let's look at this monthly. And let's go back, you know, 75 years. I'll narrow it down. But when you look at it, I know things right now feel like that everything is cratered and that life will never be the same. And that's the way it always feels when we get volatility and fear at the current level. You know, we're taking some really extreme steps by the government, by the Federal Reserve. People need to be vigilant to slow the coronavirus. You know, we had this scare, a similar scare with the swine flu back in 2010, and I guess it was into 2011, or maybe it was 2009 and 2010. I don't remember exactly when. And there was a lot of panic and fear over that back then. This will eventually pass, and the market will get over it. But in the short term, it feels like, you know, it's bad. It's bad in the near term, waking up to these headlines, these big drops and so forth. But here is the longer term look. Hopefully this makes you feel a little bit better. This was 1987, the crash. And I'm sure that when people were looking at this, we had a straight up market was an all-time high and bam, down to the, you know, quickly down a lot in a percentage, on a percentage basis. And we're going to be threatening that, especially with today's low. But I think, again, longer term, this will be a blip. Short term, it's panic. Next chart. I wanted to bring up the volatility index, and the market is opening at this point. I'm sure it's going to trigger, unless things really changed, I'm sure it's going to trigger a circuit breaker, and we'll be, hesitating or pausing here for about 15 minutes. But here on the volatility index, you can see obviously 75. We came down on Friday. I don't know where we're going to be today, but it's going to be high. Maybe we can see if it's got an update here. No, it's still showing Thursdays or Friday's close. But what I wanted to show here is I want to go back, and let's go back 15 years. I'm going to get rid of the candles. I'm going to go to an invisible chart. This is what I just like to do. We'll go 5-day simple moving average. And I don't really need any of that. All right, so here we are. This is the 5-day moving average of the VIX. Now, I'm sure we're going to get another big reading today, and so we're probably going to go up and challenge those 2008 highs in terms of a 5-day moving average. I mean, in the past, fear has been a 5-day moving average to 30. That's been an extreme. 30 has been an extreme when we go back in history. We're now at 58, almost double that, and likely to go higher with today's action. Just to give you a sense of the panic and hysteria that is out there right now. If I do the same thing with the CPCE, the equity only put call ratio, we closed at 1.03 on Friday, eclipsing what we saw back in 2008, the fourth quarter, and then also back earlier in 2008 in the first quarter. So we are almost into uncharted territory in terms of fear, in terms of the VIX and equity only put call ratio. Again, I can't make the decision for everybody. All I can do is, give you the information, give you the history. I think if I could give you one suggestion, it would be to be very, very careful about chasing anything, including moves to the upside. All of a sudden Friday, things took off. I did not buy into that craziness in the last 40 minutes. It would be easy to be thinking, oh my gosh, we got this big relief package, jump in, let me just buy. But history also tells me when you've got the volatility index up this high, you don't know what you're going to wake up to. And if we go back the S&P 500, and I'm going to bring this up, this will be the last thing, then we'll wrap up here. But if I go back to 2008, and we'll just show through 2009. Here was the move down in October. This was the big move. This was what I was showing you on my spreadsheet. It was this move, the huge volume move to the downside. We bounced 2 days later. You can see that rubber band snapping back. We went back down, put in a double bottom, another rubber band snapping back, and then one final move in 2008. We did go a little bit lower in 2009 to mark the bottom. But then we did have one more move down, and the volatility was very high then as well. So that's why I was saying I wouldn't rule out one more move. When the market's fearful and irrational, it's hard to put a rational spin on it. It's irrational. And so the selling is going to be intense. There are a lot of people that don't look at history, that don't think about long-term versus short-term. They see the headlines and they're just fearful and they sell. And the only thing I can say is that when you sell with a volatility index at peaks, normally that turns out to be a not great move. But I understand if you're fearful, I get it. If you're worried that it's going to go down another 10 or 20%, I think the question you'd have to ask yourself is, if you get out, are you going to get back in? Are you going to get out and then try to get back in 10% lower? I mean, that might work. 10% lower today. If you did that on Friday, it would have worked this morning. But trying to time that exact bottom when that rubber band snaps is difficult. And what happens if you sell, you panic sell, and the next thing you see the market back up 10%, and then it doesn't come back down. You see the next day it's up a couple percent, then another. It really wears on you. So again, if you're long-term, it's up to you. You got to make your decision. but long-term generally benefits by holding through these periods. Short-term, you've just got to make a decision with the VIX up here, what your strategy is to get back in. And that could be different for different folks. All right, we went a little bit over today, but I know it's a really bad time in the market. I want to spend a little bit more time and hopefully give you a little sense of history and a little bit about fear and what it's meant in the past and how things tend to come back, sometimes very quickly. And so at least give you information to process before making decisions. Anyhow, with that, I'm going to go ahead and wrap up. I'll be back tomorrow over at Stock Charts. Stock Charts is actually, going through a modified schedule as well. I don't know how many of you know it, but they're out in the Seattle area, which has been hit very hard with the coronavirus. And so I may be recording shows and then playing them in my normal 9 o'clock time over there. There's a lot of that discussion going on right now. So I'm just not sure what my shows will be looking like, but I will be back tomorrow at 9 a.m. over there. It might even be a replay of something I've done in the past tomorrow while they're sorting things out. I don't know. But I'll be back here for sure live on Wednesday, and we'll see where we are. One other thing to keep in mind, too, the Fed is going to meet again Tuesday and Wednesday of this week, and options expire on Friday. And there are a ton of in-the-money put options right now. We saw what happened to all those in-the-money call options in February. So just keep that in the back of your mind as well. Anyway, everybody have a great day. I'll be back tomorrow at Stock Charts Wednesday right here at EarningsBeats, and hopefully see you then. Take care. Happy trading, everybody.